Good evening, everyone, and welcome to NGEN Markets training session. So I hope I'm audible to everyone and the screen is also visible to everyone. Meanwhile, a few participants are still joining, so we can wait for them. Until then, I'm going to discuss about what are the topics we are going to discuss for this particular session. So today's topic is all about how to effectively use portfolio comparison for acquiring new client and also how to assess existing client via using portfolio comparisons. So I will be showing you several use cases by comparing two portfolios and to see which one is giving you better value as an advisor and how it can help you to convince any client who is having some different position in different mutual fund portfolios. And then we are going to have a Q&A session in the end. So any questions you have, you can ping us via chat or verbally. We will definitely answer them. So let's go ahead with the session. I hope I'm audible and the screen is visible. If not, please let me know. So I'm just give me a moment. I'm sharing my terminal here. So here we are onboarded into the NGEN market system. I hope it is visible to everyone. So in this system, as you can see, there are several ways to add clients. So now we are talking about a new client. So to just show you an overview how to add a new clients, all you have to do here is you have to come into this portfolio section, a model portfolio section, where you can click on this add a new portfolio and you can add in clients. There are two ways to add clients. One is manually adding those funds, let's say a fund like something like that, and you add them. Or other way is uploading options. We have given CDSL, CAS PDF, which is shown like this, NSDL and CAM summary report, or an ISIN from Excel, where all you have to do is put in ISIN number with the example of percentage amount or unit, and all you have to do is validate the input. Once you validate the input, you can see this kind of a portfolio is onboarded and you can name the client, let's say client one. So this is an overview which you can do it yourself and see how many clients you can onboard into this section. Another thing we are going to talk about is that once you have onboarded new clients, you can add them into the folders. So why it is important? Because we have given several folders here, and you can also create new folders. So by the way, to create new folders, all you have to do is come here. And if you, let's say, if you want to add this particular folder, this particular portfolio into a new folder, all you have to do is click on this button, move to, and click on new folder. Why this is important? Because if you have a new folder such as, let's say, model portfolios 2, so this will help you to create repositories, to create folders in different model portfolios, and then it will be easy for you to gauge where your portfolios you have kept in which particular folder. So as you can see, there is model portfolios 2 is added here. Now you can see one portfolio is added. Now let's go ahead with our main topic, as we are going to discuss about how we can compare portfolios and how we can gauge in how if a new client is added into our system, how we can compare it with our model portfolio and come up with our own analysis. So let's say there is one use case here is that, let's say we add in a new client. So I've already added a new client portfolio here in the left side. So here you can add in a client's portfolio in the left side, and in the right side you can add in a model portfolio. So to add in a model portfolio, all you have to do here is come here in the into this particular drop down list, and then all you have to do is you have to select that particular model portfolio. So in this section, I have some of the model portfolios such as moderately high risk and conservative, and there is a balance strategy as well. I can compare several strategies against this client and see which one is actually suitably beating the new client's portfolio. Let's go with a balance strategy first. So here you can see that no, my balance strategy is actually not beating the client's portfolio. So that doesn't make any sense to go with such a balance strategy. Yes, there are equal allocations given, but still I'm not beating this particular portfolio. You can change those allocation as per as you want, and see if your balance strategy is actually beating this new client portfolio. Let's go ahead with another portfolio which is a moderately high risk. Let's say we are going to take more risk and we are going to give more returns. And yes, you can see accordingly that the moderately high risk which we have taken within equal weightages is actually beating the new client's portfolio. So now let's drill down and let's see what are the intricate details which we are achieving through this model portfolio. One is that we are getting an annual return difference of 2.97%. So annually we are beating this particular portfolio by this particular margin. And then you can also change in the date. So let's say we change in a custom date accordingly, let's say from 2016. And all you have to do is you have to click on this and click go. Once you change in the date, definitely you will see some differences in annual return difference. And here you can see this is the difference. So this is 2.91. So accordingly, you can also see that the Sharpe ratio difference between our model portfolio and our new client portfolio is actually higher. So what does that mean? It means that we are taking similar risk, but giving you better returns. And here we have given lots of parameters between MTD till 5 years. These are all the returns, and also the cumulative return, annual return, and annual volatility and the Sharpe ratio. And then we have given the up months and the down months as well. So one thing here is that the up months is actually we were more positive, more months we were positive, and in the down months we were actually lesser down. You can see -4. So basically we are actually a better portfolio due to this kind of up months and down months. And similarly, you can also see the down years. In this case, down years is 2, so basically it's 0. But that gives you a good scenario as to what are the parameters and what are the differences between the parameters between these two portfolios. Then we can go ahead with an asset allocation. Now, in this case, the asset allocation is quite different like this. So here, this particular portfolio is actually having a high pharmaceutical exposure. Now, pharmaceuticals as an entire sector would have been a great option in 2020 because of COVID scenario. But in this particular, sense, if you see that we are starting our custom start date from 2016, banking would have been a better option because here in this equity sectors, we can see banking and IT software. So this gives you a sectoral overview as to if the client is highly into pharmaceuticals, why not you could go for banking and IT software. And you can also state in such other details such as the exposures between those particular small cap, large cap, is lesser or higher accordingly based on the portfolio you have chosen. And in the debt side, there is a comparison as well. You can compare the portfolio credit ratings between the sovereign AAA equivalent, and you can also see the average maturity, average duration based on the debt side, and you can see based on what we have added. So that we can actually look into. So here it is ICICI Pru floating interest fund, whereas here we have ICICI Prudential Balance Advantage, which is hybrid fund. So this comparisons gives you an overview as to what the client's portfolio is actually lacking and how this moderately high risk portfolio is actually solving those problems. Then only a client acquisition can be actually possible with all the parameters, not just with returns. With performance, definitely we are beating this particular portfolio, but based on asset allocation, we are showing some intricate details as to what we are actually achieving through this moderately high risk portfolio. Similarly, you can also look into the exposures. The exposures here is Sun Pharma, self-explanatory, and here we have ICICI Bank, which are banking. So you can compare those, top equity sectors based on that, and you can say that the pharmaceutical exposure are too much for this portfolio. We need to reduce those pharmaceutical exposures and make it banking as a highest or IT as a highest for as of now, because this sector is, according to you as an advisor or a distributor, if you have some thinking based on the sector that these sectors are gonna be performing better than pharmaceuticals, then definitely the portfolio should be rebalanced or restructured based on this particular analysis. And you can also see the market cap exposure differences between them, as in this case we have higher large cap exposure. So as of now, in this particular scenario, having a better large cap exposure is actually gonna give us more returns. So this analysis, this comparisons can give you an in-depth overview between the two portfolios. And here we also have rolling returns. Now, rolling return gives you the expectancy in the sense that what is our average 6 month and 1 year rolling return, and based on that we can compare and we can see that this is the particular average for the 6 month period and for the 1 year period. So if we are investing for a 1 year period from the last from the last 2016, which is 5 to 6 years, approximately what is going to be our average for a 1 year period. So definitely we are actually giving a better average based on rolling returns, and the volatility in the sense is actually quite similar. So we are taking a similar risk but giving you better returns, even having a moderately high risk portfolio. So if we add in a conservative portfolio, there might be a different scenario altogether. Then we can go into drawdowns. Now drawdowns are, one analysis is that whenever there is a drawdown, how many days it takes to recover. Now in this case, there is still ongoing a loss, which is a current loss. You can see this is a current one. But if we just look into others, as an example, if we see that in 2018 it took 317 days to actually recover, and similarly in 2018 we just took 11 111 days. So you can compare those recovery days, those top drawdowns, and make those intricate comparisons. There might be some scenarios where your recovery days might be higher than the recovery days of your client, but it depends, because in 2020 pharma sector, the exposure of pharma sector in this portfolio was very much high, and due to that the recovery was high. And that is very important, because whenever you tell that, whenever a client can question you that, this recovery day is low, why should I go for this? So you can have some details comparison between asset allocation, and you can say that these are the reasons, and I would like you to say that, these are the different sectors you can go through, because you're going to invest in moderately high risk. Now here in this case it is equal weightages we have given. What if we optimize this portfolio, or what if you have done some permutations and combinations and change this allocation to give a better performance based on those allocation? So what you can do here is, you can come in the left side. I have already added my model portfolios here. So this is the one which we are talking about, moderately high risk, and we can run this. Once we run this, based on the portfolio improve, or based on your understanding as to which fund should be given better asset allocation, you can choose those particular funds accordingly. So here in this case, we can choose any single model. So I'm just gonna give you brief overview as this is that we have two sets of models. Within that we have 6 subsets. In 2 sets we have one is ranking model, and another one is actually a value model. Now based on that, we originally opt for 18.22 having an equal weightages. We can use any other model, let's say a value model as our own model portfolio as optimized one, because this value model is actually giving you 19.02 against the original, and keeping the volatility similar, so our Sharpe ratio is increasing. You can save this and you can create it as per needed. Once you have created that, you can conservatively save it. Once you have saved it, you can do it for any other portfolio altogether, and you can come into this portfolios, compare to portfolios. Now here in this case we already have a new client portfolio onboarded. Let's say we are comparing our model portfolio with an optimized version. So before going ahead, you can see that with equal weightages we are having an annual return difference of 2.91. We can achieve more if we have a better allocation. To achieve that, all you have to do is you have to just look for that particular model portfolio which we have saved, and accordingly you can see that our annual return difference has increased. Now here even a Sharpe ratio has increased. So it means we are taking lesser risk, or maybe similar risk, and giving you better returns. So that's how you can do those comparisons permutations and combinations between the two portfolios, and come up with your suggestion based on what would be the better allocation for the client. You might not want to go to access small cap too much highly. It is 40.82, so not advisable, but you might take in a look into what are the better allocations based on that. So I've just taken this as an example, but you can use your due diligence. You can use this entire terminal to see what is the best allocation for the client, and make and see what are the performances, how the drawdowns are working in between them, and that is how this works out. So this is one thing. And let's say we this new client portfolio, uh, you want to add in some new exposures. You want to remove some funds from this client portfolio, and you want to see what if I change only couple of funds, and what if if I change, will that make some differences in performances or not. That can be doable when you come into the new client portfolio. All you have to do is run this portfolio. Once you run it, you can click on this edit and save. And once you click on edit and save, you can see these are the funds which are given here. Now you might have guessed up, or you might have already done your own analysis, and you can see accordingly that there are too many mid caps here. So you might want to reduce those mid caps. So you can remove this one as an example. We can let's say let me just come again. Give me a moment. Yeah, this one. Okay. So in this case, once we edit it, as an example, you can see there are some mid cap exposures. So you can remove those mid cap exposures here. And in this case, once you have removed them, you can add other funds. So I'm just removing this one as well. So once you have added this, you can and type in any fund, let's say an ETF, a Nasdaq ETF. A different example for a foreign securities, you add in a Nasdaq ETF here, as in let's say this one. Once you have added it, let's get an exposure of 25%, and let's see if we actually are having a differences between the client one and our portfolio. We can update it, or you can run it. If we update it, it's gonna overwrite the client portfolio, but we want to save it as new to compare these two portfolios. So all you have to do here is save as new and add in the portfolio. So let's say we add in client one modified. So once we have added that, we can create it. So once this is created, we can try to compare if the changes we have made, this client one changes we have actually made, is making sense or not. So in the right side, we are just gonna add it our own modified one. So this one. So once you have added it, you can see it does make sense. I mean, if you have made changes like removing some mid cap exposures, keeping DSP mid cap as your key mid cap fund, and you can also remove Franklin India blue chip, because these two are highly correlated. So maybe you can remove blue chip and add in some other blue chip altogether to give another exposure. So in this case, you can see there is a return difference of 3.82 accordingly. So that's how you can add in multiple foreign securities, like ETFs. You can add in a custom security as well. You can come back and review the portfolio again. Let's say the modified one which we are talking about, we edit it, and we say that okay, we can change it to 15%, and we can add in an Apple stock. Now this is completely different, but it makes a difference here, because once we rescale it, now we are gonna update it, or run it. Once we update this, we can try to see what our modified version is actually gonna show. So here, let me cancel this up. Let me come up in this compare section and load again the modified one which I have loaded. So with an Apple stock, yeah, so you can see it is quite giving you high annual return difference. So in this case, you can change in any securities. You can add in even an Indian domestic stock into this portfolio, to see if the comparisons between the two portfolios is making sense out of it or not. Sometimes what happens, we think that we have chosen the best fund from the comparisons, and we might have gotten wrong in our analysis, and we can check that by comparing two portfolios if it is making sense or not. So after making the comparisons, all you have to do here is you have to create the PDF. But before creating the PDF, we're gonna do one more use case here. The use case here is that, let's say there is a client which is having no investments with you, with anyone, have not done any investment in the capital market via stock or mutual fund. So what you're going to do, if the such a client approaches, sometimes the client say that I want to invest in direct equity and not in mutual funds. So what you can do is you can add in those particular stocks portfolio here. And I'm just adding any random stock portfolio. Just give me a moment. And you can add in a mutual fund portfolio beside it, and you can compare it. So this gives you an idea as to if the stock portfolio we have chosen is actually better than the mutual fund portfolio which we are going into. So just give me a moment, I'm just looking into the stocks portfolio. Okay, so these one. So let's say as an example, I've just added 4 stocks, but there might be not 4, like 5 to 10 stocks you have added. And in the right side, you can go for any mutual fund portfolio or any model portfolio which you have. So let's say this one, which is our defaulted one. And if we compare it, you can see we still have an annual return difference. Now what is the key here is that if a client is telling you that let's go for like 5 to 6 or 10 stocks, you can add those stocks, make proper allocations even in this particular portfolios, such as this, and try to see if it is making sense to either go for a moderately high risk model portfolio of a mutual fund, or either going for a direct equity. This makes a lot of sense, because when you look into asset allocation, we are highly diversified into the sectors. Whereas the client might even it is fairly general that the client only looks for those stocks which are highly performing in power, or in some sectors, and it might go for like 4 to 5 sectors or 6 sectors, but not more than that if you are going for direct equity. So this makes sense that if I want to be a diversified if I want to be diversified in my approach, and if I want to have some debt securities as well, this makes a lot of sense. And this even with a risk, you can see that our risk is actually better. Our risk is lesser, because we are taking a similar risk and giving you better returns. So that makes a lot of sense when you try to compare between a stock portfolio and a mutual fund portfolio. And in the end, whenever you want to make a report out of this, all you have to do here is you just add in the client here, any client, whatever it is, and to compare them and to create a PDF out of it, you can create a PDF here. Now in this case, we have given 2 ways. One is a standard PDF. Once I click on it, a standard way of PDF is just shown to you, which will just show the asset allocation based on percentages. But if you choose in a capital based PDF, it will show you let me just show you the PDF now, then it will be completely explanatory here. So this is a PDF, a standard PDF, which shows you based on the percentages. What do I mean by percentages? The asset allocation. So here is the comparative performance between the new client and the model portfolio, which we have done before. And here is the comparison between the asset allocation between those 2 portfolios. And here is the comparison between the rolling analysis and the volatility. And here we have the portfolio composition. Now in this case, you can see these are the percentages. What if we have invested 1 crore in both of the portfolio? Now this makes sense that where my 29 lakhs are going in, or where my 25 lakhs are going in. To do that, all you have to do here is to come back and to click on this create PDF and type in that particular amount. So it can be 1 crore, it can be 10 lakhs, doesn't matter. All you have to do is click go, and a new PDF will be generated based on the capital which we have given. So based on that capital, you can see that my 29 lakh is going for Nippon India Pharma, whereas the changes we have made, we can say that in Nasdaq we are actually having 24.97 lakhs, and that is a good kind of an information when you have a decent conversation with your client. And in this case as well, you can change accordingly with your permutation combination. And we have also given a download button in Excel where you can download the entire data. And we have also given a screenshot button which will help you to screenshot any any portfolios you have inputted. And we have also given a custom start date, so it takes into account the minimum common period altogether. So we have to always look into that as well. Now, one more thing here is not just the portfolio from this portfolio section you can compare. You can also compare your own clients' portfolios. So own clients in the sense, let's say you already have RTA connection with us. With RT connection, we have a weekly syncage where all your clients will be onboarded via CAMS and Kavi. Now, let's say you have this client called as Sam Bedi. Now, all you have to do is you have to click on this and you can see that this is the client. Now, you want to compare this portfolio with your own model portfolio. So, all you have to do is you have to click on this. If you click on this, it will copy this client to the portfolio section. So, if you click on it, you can see it already exists. But when you come into this section and when you collapse all, when you click on this collapse all, you can see there is a folder called from clients. This just means that it has been onboarded from the client section. So all you have to do is you have to click on this, and here you can generally search where is the client. So you can see this is the Sam Bedi which we are talking about. Now what you have to do here is you can just come here into the compare section and add in that particular client. So we can just look into that client here, and we can try to make a sense out of it that the model portfolio which we are trying to compare is making sense or not. So this is our existing client altogether, and might be what we can do is we can make changes into his portfolio which I have shown you before, and compare those changes. If that makes sense, you can actually tell the client that you should remove DSP small cap, or you might want to remove prudential blue chip, prudential balance advantage from the portfolio. So the reason behind them can be any reason, can be a performance reason, can be an asset allocation reason, or maybe a drawdown reason. So these reasons can help you to convey to your existing client as well that why are you trying to convey, why are you trying to suggest different funds rather than the portfolio he's holding right now. So this is all about the entire session about the portfolio comparison, and that is how the client acquisition works out, because you're trying to convey what is better based on the changes you have made, or maybe you can say the advisor or a distributor alpha you're trying to create for the client. That value addition will help you in even acquiring the client, or even conveying different securities which you believe are better for your client to your existing client. So that is it for the entire session. And if we can start with the Q&A session, so we have Arunab sir on board as well. So please everyone, you can shoot your questions on chat or verbally. So are there any questions?
Hello.
Yes.
Yeah, Ashok Agarwal this side. I just wanted to understand, like in a portfolio, normally you see this, what do you call, the chart which shows that the backward integration where the existing portfolio exactly this point. So how does you arrive to this point? And the return shown by this your calculation is the actual return of the portfolio, or it is a return which is different from the portfolio because the client's investments are in form of SIP, or the duration may be different. So I have a doubt whether the return showed in this is exactly as per the return of the customer, or it's a different, there's a variation in the return shown here and the actual returns.
Yeah, sure. Hi, this is Arunab here. So firstly, we are not showing the actual return of the client because that is something that's already happened. So this is not a process where we are reporting, what the client did as a result of the SIPs, their redemptions, their subscriptions, etc. What we are showing is the latest portfolio that the client holds today, and trying to analyze whether or not that is good or does it need to be changed. So firstly, what we are doing is we are backtesting latest portfolios, so they will not represent the client's actual return. So that's the first thing, because from our perspective, when you look at it, you can easily report their current XIRR, whatever has happened, but that may be that will not be affected. That will be affected by what decisions they have made. But if you apply your latest holdings to the actual market movements, then you get an idea of how good your current portfolio is, which is the only thing that matters as far as future returns are concerned. What we don't show here is we don't show clients' actual P&L. We show you a backtested version of what is currently there. And then obviously in comparison, we show you another portfolio which you can choose to see whether or not that makes a better difference. So here, in this case, what you're looking at is basically two sets of funds, obviously weighted in different ways. And one of them is performing better than the other. And these are historical prices of portfolios. So they are important to look at in the same way that you look at the historical price of a fund, whether or not you have bought it. So when you look at a stock, Reliance stock, you have not always been long Reliance stock your whole life, but you're still going to look at the historical price of that stock. In the same way, if you're holding a portfolio today, you need to check the historical price of that portfolio, which is what this is. So it is not the P&L of the client. This is the historical price of the current portfolio that you're looking at. And it's very important to look at in terms of having future expectations of what I can get from it. Just exactly in the same way that you would do for one single stock or a single fund. So you'll always be looking at backtests. And in this case, you can look, on the left side as a 19 position portfolio. Is it really adding diversification to me? On the right side, you've got a portfolio with only 6 funds. Obviously, we can go through other things like asset allocations and exposures to see what kind of difference it makes. But there seems to be no sense in having so many funds in a portfolio when you can get a much better risk return stats with just a handful of funds with reasonable diversification. So that would be the case in this example. I hope that helps.
Yeah, that's fine. But can we have something wherein we get a backtested return also, as well as the current actual return of the client? So that
the problem is this is not available anywhere, because what you're asking for is the actual return over time of the client's transactions.
Yes.
Right. Even your back office system cannot make a historical chart of this. The back office system will also give you XIRR. They will tell you Axis Small Cap Fund, your XIRR is 18%, 19%, whatever it is. And that is based on all the transactions that you've done over time on Axis Small Cap. For that, you will also have to give us every single transaction that has ever happened in the client portfolio. And then you have to do a mark to market on every single day of that portfolio as the changes come and go. So that is a much, much bigger exercise. That's a reporting exercise, basically telling them abhi tak kya hua, right? But again, like I said, firstly, practically speaking, that is not so easy to do. And we are not aware of any system that actually does that. Like I said, they will give you final results that this is the XIRR of the portfolio, but they will certainly not give you a historical chart which is rebased at 100, because you can see if you have a client who has started 5 years ago with 5 lakhs and over time they've kept investing, now they have 50 lakhs, right? Now you're going to show them a chart. Obviously that will be a percentage charge. If this is a rupee chart, it will not make any sense because 5 will become 50. So obviously it had to be a percentage based chart, which starts at like a theoretical number like 100 and slowly keeps growing as your investments make money. Then you take something out, then there's a drawdown, etc. All of that is basically, currently, I don't think there is any system that is able to, accurately do that for you.
You have this tie-up with Fund Expedia or those two back office.
Yes,
so that will generate the XIRR, right?
Yes, but the XIRR will not be able to generate this chart. You see, because the XIRR will only give you the final point.
Agreed. So that will give you an XIRR, and this will give you the backtested returns, right?
Yes.
So those two can simultaneously be presented on a single sheet or not?
See, those two can only be simultaneously presented if we have access to every single transaction that your particular client has had through the fund expert connection. So that, currently through fund expert, what we get is access to your latest holdings, which is in the client section. But again, I would stress that, it's one thing to look at the client's actual performance. I understand that that's what the client wants to see, but from our perspective, that is actually irrelevant as far as the future is concerned, because like I said, it's just like jo ho gaya so ho gaya. The point is that what's going to happen tomorrow depends on only one thing, which is what you're holding today. It does not depend on whether or not you did few SIPs 3 years ago. That has no effect. So it is good to know what had happened to report of the past. But if we're talking of the future and making decisions for the future, the only thing that is relevant is today's holdings.
And the backtesting figure where you match that they both are at the same level, how is this arrived at?
Sure. So basically, we assume theoretically that you started on the start date 2nd May 2016. Right. And we run two different P&L calculations, one on the left, one on the right. And for each one, we assume that you have held this portfolio, and we show you the return that you would have had if you held this portfolio throughout the time period shown here. So what this does, it actually gives you a great idea of what kind of reaction this portfolio has to different markets. You can see how one portfolio, for example, let's go to drawdowns for a second. You can see that one portfolio on the left, lost 31% during the lockdown period. So 25 Jan up to the beginning of the lockdown, the worst day the market was probably 23rd March. So it lost 31%, and it took 127 days to recover. On the right side, it lost 2 more percent, right? This portfolio, and the dates are also slightly different. You can see recovery took a little longer time. But the next drawdown, you can see 2018 on the left side is 13%. Recovery is 300 days. 300 working days is more than 1 year. And on this right side, this recovery was much, much quicker. And actually, if you look at the chart, you can also kind of see that. So this is where you see how these two different portfolios, which this is basically a choice. Should I invest in a portfolio today, which is made up of 19 funds as on the left side, or should I invest in a portfolio today, which is made up of 6 funds, which is on the right side? That's a decision you have to make today. And that decision will definitely affect the next 6 months of returns or 1 year of returns, which is why all our analysis is focused on latest portfolios. So we are not, at least as of now, focusing on reporting what has already happened. That data you do get from back office systems. What we are focusing on is kind of forward-looking research in terms of how you can make your portfolio better for the future.
Okay. Now, suppose like one portfolio and a customer has created a portfolio, let's assume, say in 2019, right?
Yeah.
And it has, during backtesting with a model portfolio, I see that my portfolio is giving a better return as on date, right?
Yes.
But the customer's present portfolio, which he has started in 2019, as on date, it is giving much better return than the comparison that we have created. So how do we justify that?
Well, if your customer has a current portfolio that is giving a better return than what you're backtesting today, right? Yeah. When you say in the first case, how are you coming up with those returns? Are they the actual XIRR that they've received?
No, I'm saying, let's assume customer invested 1 crore in 2019, right?
Yeah.
Assuming in 4 funds.
Fine.
Now we have a model portfolio of, say, let's say 6 funds. Yeah. And we backtest it, and as on date, we see that the model portfolio is giving a return of, let's assume, is showing a return of, let's say, 15%, while the client's portfolio return is showing us 13%. But actually, as on date, the client's portfolio is giving a return of 17% because he has invested in 2019. instead of 2017 where we were at the same level. So how do we justify that?
Sure. So see, again, the thing is, if you want to do the comparison on exact dates, first, one thing you can do is change the custom start date to exactly when they started their investment to 2019 and see the kind of result you get, right? Because then your model portfolio will also run from 2019 and you'll do a fair comparison, right?
Okay.
Right. So in this case, if let's say they actually started on 1st May 2019, you can say, okay, this is what happened. Return wise, in this case, we are getting a better result with the model portfolio, but you might not get a better result with the model portfolio. In that case, then a decision is up to you that, you know, how you present your case, because you can say that, look, this is just a 2-3 years, right? Now there are return cannot be the only deciding factor, at least should not be the only deciding factor. Because if that was it, we should all just buy, you know, Reliance and Bajaj Finserv and let it be, right? So obviously we have to look at other things like asset allocation. Is there some balance there? We have to look at volatility. We have to look at rolling returns. We have to look at everything in the whole thing in totality to make a reasonable decision. We have to look at drawdowns. What kind of losses can the client take? Maybe the return on the left side is good, but are you okay to be down 30%, 12%, etc., etc.? And are you okay for 2 drawdowns or 3 drawdowns to not be recovered? I mean, look at the left-hand side. There are 3 drawdowns. Somebody who started this portfolio in November, October, November last year is going to be pretty frustrated by now. So you have to obviously take those into account as well. So, but equating the start date will solve the problem you're asking for. But again, the more backtest that you can do, the better it is. Why? Because it will go show you how your portfolio would have done over longer periods of time, and thereby going through various different market cycles also. Now, COVID is a great example for testing a portfolio. That has already happened. We have that history now. 2018 also, you can see how it went through different political problems, etc. So the longer you can backtest something, the better it is, because it stresses your portfolio's history to see how it can respond to problems. I mean, technically, most analysis is about that only, right? To see how it will deal with problems. When the returns are good, nobody's crying, everybody's happy. It's the problem when things go bad, what do you do?
So the most important thing is, once we share any output in forms of PDF or PowerPoint to the client, we have to tell him very clearly the return shown is not the actual return. It is a backtested return. So you don't assume कि आप बोल रहे हैं कि आपका तो return 18% आ रहा है, but इसमें 14 दिखा रहा है. That should be very made clear before sharing.
Very clear. And उसके ऊपर, I would say you should also explain to the client why backtesting is important.
Right.
Because they could have just been done 4-5% extra because they were lucky कि उनका SIP का timing सही हो गया. Or they were lucky कि उनको they needed some money, they did some redemption, उसके बाद market गिर गया. And उसके बाद जब वापस डाला तो bottom पे था तो ऊपर आ गए. Now, अब वो next time नहीं होगा. So
every time it won't happen, right?
100% नहीं होगा, right? हाँ, so that they must realize that वो luck की बात है. But when we're testing a portfolio, we are being fair because start dates भी same है, market same है, underlying assumptions सारे same है, and we are putting them side by side. So it takes some time for them to grasp it, for regular non-finance people to grasp it, but they do grasp it. Like I have had this conversation many times with people, and they have agreed that. And I think the biggest argument that does work at least has worked for me, is that the only thing that affects your future is what you're holding today. Right. आपने कल Reliance stock खरीद के बेच दिया, अब उसका कोई फर्क नहीं पड़ता. अभी आपके पास Reliance नहीं है ना, तो क्या फर्क पड़ रहा है? So that's the main thing. What you're holding today is the only thing that matters, nothing else.
Got it. Yeah. Right. Thank you very much.
No problem, sir.
Okay. I'm Rajshekar here. See, one
Hello,
question on this Hello, can you hear me?
Yeah, please go ahead.
Okay. On this portfolio improvement, that feature that we have here.
Yeah.
See, I have tried. I've not used extensively, but I have tried on few cases. See, when someone is planning to hold the portfolio for next 5 years, I thought it is good for me to see the previous 5 years, how this portfolio has done, and then see, what we can learn out of it. But when I do this, the output that comes, it shows very abnormal, like small cap 50%, mid cap and all. And obviously, because I think it is looking at previous,
correct. Yes.
Previous performance, and then a small and mid cap saw a huge rally in the last 2 years.
Yes.
So obviously, it may be projecting that investing more in this is, which goes against the logic, because if someone is moderately aggressive, we obviously don't give significant mid and small cap. In fact, small cap we don't even give by common logic. Now, if I go for a very long time, 10 years kind of stuff, I don't know if it makes any sense, because if someone is not going to hold it for 10 years in future, and also portfolio managers have changed in many schemes, even the objective itself has got changed and other stuff.
Yes.
So what are your thoughts and ideas on how we can
so here, sir, one thing I can suggest is, for example, look at the minimum vol model result, right? Now, this minimum vol model result is a bit skewed because of one particular floating rate interest fund in here. So can we get rid of that and just run this again? Because we've got like a straight line fund in this, so obviously just rescale, and then, so let's assume they are decent, we've got some decent equity fund in here.
When you did rescale, where did that percentage, it has to be allotted to some other fund, right? So it automatically.
You can either do that. I mean, it was a debt fund. So what we did is proportionally increased everything else to fill that space, right?
Okay. So if I do rescale, then it gives equal quantum to each of these funds.
Well, it won't be equal. It may be proportional to their weight. So if something, something that is small will be increased only small. Yeah.
Okay.
So let's run this and then run the optimizer.
I didn't know rescale. I manually add the percentage all the time.
No, you can easily just rescale, and that's the actually mathematically right way to do it. If you remove something, you can just rescale. Everything stays the same. Everything else stays the same, but fills up to 100 in the same way that it is currently formed. Okay. So here now, what you can do is you can try to look at like this minimum vol, both in the not more so much in the rank, but in the value model. So if you take the next one, the minimum vol, this one. So you are absolutely right when you say that the return and the sharp models, they are looking at past returns. So if small caps or whatever has done really well last 2-3 years, they will get high weightage. You're absolutely right. So it's more like a trend trading model. It is getting on the backs of whatever is doing well and expecting that good performance will continue, right? Now, as you rightly said, that doesn't necessarily need to be the case. So the volatility model in this way is actually very useful. So this, by the way, you can run the optimizer, not only your entire portfolio all the time. Sometimes you can break your portfolio into 2 parts, optimize them separately. You might have to just fiddle around here, just, create 1 or 2 copies of your portfolio, remove the dead parts, and then put them together again. But the main point here is that you can easily take a bunch of equity funds, which are, you can say, I don't care whether the past performance is good or not. I like these funds because I know the fund managers, I know their method, and I trust these guys, etc., etc. Right. But this vol model, what it will do is it will give you some stability, because what it will do is it will look at the volatility of each and give you a slightly higher weightage towards the equity funds that are low vol. Now, this is generally very well researched that when looking at equities, low volatility stocks tend to outperform higher volatility stocks over the long term. Now, again, it's a big themed saying. Doesn't mean it's always going to be correct, but low volatility is obviously generally considered a good thing. So in this case, you can ignore the return and sharp models, because they are, as you correctly said, focused only on performance, right? Sharp is half focused on performance, because this is also not a bad consideration, because sharp itself is half volatility, half return. So it is risk adjusted return. It's giving you the best weightage based on your return divided by your vol, not just your return, which is the first one. And volatility is not looking at return at all. So here you can use the vol models as well, which is the reason we put it in there, to optimize a portfolio which you have already pre-selected as having decent funds.
Okay.
Yeah, and generally, Yeah.
Because we anyway select funds based on our experience.
Exactly. And your experience will be better than just looking at past returns, right? Yeah. So then you can use the vol model to add some stability, right, to your selection. It is not changing the funds. It is just giving you a slightly, well thought out weighting scheme rather than just 5, 5, 5, 10, 10, 15, right?
Okay.
So, and also, repeating this process every 2 to 3 months just to see what the vol model is saying now. Is it very different from what I have? Then maybe I should think about it. If not, then let it be. But this is one place where you can just keep coming back every few months and reviewing.
Okay. Then, this is interesting for me to know. So this is in the value models, we should look at the center one, right? Minimum vol.
Yeah, minimum vol. This one for the value model. You can also look at the ranking model. But ranking model, like I said, is very aggressive. So you can see what is done. It's said, I like Aditya Birla Sun Life MNC fund because it's probably quite low vol, right? So it's given it quite a lot of money, right? But the value model minimum vol is a bit more balanced. So this is your choice, basically.
Right. Okay. The second one in this portfolio, after I will try this one also and then see how the results come. But now when I look at this overall portfolio and its results, and I see up capture ratio, down capture ratio, in quite a few cases, I got up capture ratio as only 70 or something, better down capture ratio like 40, 50 kind of stuff.
Yeah.
Now, if I want to increase that 70 to say 80 or 90, is there any other run we can do here just to know, which one if I increase?
I'm not aware of any such method. The only method is a mathematical method where we run various different simulations and then pick out the portfolios which happen to have a higher app capture ratio. I'm not.
So individual fund, I can check and see which one had.
Yeah, but manually it is impossible to do it because what we would have to do is, let's say run 100 different portfolios with slight variations in the portfolio weights, right? To see if any of the possibilities can increase the up capture ratio from 83 to let's say 90, right? And then we say that, look, here we find a portfolio where the up capture ratio is quite high compared to what you have. But in that case, this will be an optimization process which targets the up capture ratio. But I'm not aware of any method that would increase it. But again, also up capture ratio, remember that it's very, very subjective based on the benchmark you have. So, my question will be, okay, you have a nice up capture ratio. What does that mean for returns, right? It just means that it does well when the benchmark is up, etc., or does better. But better than what? So it is also subjective to the benchmark as well.
Okay. Then it is not, it's not absolute. So it is.
Yeah, because you can see, he just changed the benchmark and it's already gone up to 88, right? You might be able to find a benchmark where the up capture ratio is even better.
Okay. I didn't know that.
Yeah.
All right.
Because see, sir, that is why it is in the relative section. You just scroll down a little bit. You can see performance versus S&P 500. And then all of these stats below are relative to the benchmark. The ones that are above are independent stats.
Right. Okay. All right. My third question, I think Nikhil also had asked this question on the chat box.
Sure.
Is the model portfolios that Umesh showed some time back. When you just for our learning, we have our own way of defining what is aggressive, moderately aggressive, and other stuff.
Yes.
But since you have already prepared a few, I just want to know, how, on what basis, moderately aggressive portfolio.
So we do a few methods on our side. Most of them are like quantitative in nature, in the sense that they are mathematically done, right? So it is not based on market knowledge or fundamentals or market views or personal views. It is based on just simple mathematics. So, we did actually think about making some model portfolios which are mathematically generated available on our site. But I think there is some confusion there about whether or not that would be construed as advice, because we are a technology platform. We are not supposed to be giving out portfolios like this. I think Dave can comment on it, but it's something maybe we can in the future, think about doing. I don't know if Dave has any views on whether it's okay to put model portfolios out in the public?
No, I think we can't do this, sir, because to put a model portfolio would be a kind of, we are then coming into the advisory, and for that there are a lot of SEBI regulations, and frankly speaking, we want to be independent to the IFA fraternity and advisory. We don't want to get into this section at all.
Okay.
So the suggesting a model portfolio would be not the right thing for us as an independent platform.
Sure. No, I get that point. Yeah, it's understandable. So that's fine. My last question is not necessarily on the tool you took us through this week, but just after using this software for the last couple of months, one feature, if at all it is possible sometime in future, is you have given SIP feature there, but we don't have an SWP feature, which we normally use for simulating some scenarios for showing it to our retired people. So
yes, sir. So this is been on the list for a while. It's definitely on the list, and I'm hoping it will get done soon. We are just about to release something pretty major in the next week or so. But yeah, there have been some delays, mostly because we have so much other features that we've been working on. But SWP is definitely something we will put in this section here.
Oh, fine, great. Not necessarily immediately, but at some point of time, because
Definitely.
especially for retired people, we do simulation.
Yes.
So we
Definitely.
now use some other sources, but they are not as comprehensive as we are able to
Understand.
use on NGEN. So
Perfect.
all right. Well, thank you so much.
No
Thank you.
problem.
Thanks.
One last question.
Yeah, please.
Okay. How can we identify which sector, like suppose I want to give an exposure to an auto and power sector to the client. So which fund has a higher exposure to these stocks? So how can we check which fund has exposure to auto and power sector or something like that?
Sure. So you could check out the funds holding analysis section here. So here, if you go here, you can basically look at various different sectors. So for example, let's say you were looking at chemicals. I'm just taking something at random, right? So then you look at the latest column in the chemicals line, and you see 4% is the average portfolio holding in the chemical sector. Then you click on it. So when you click on it, this will open up. It will show you, and you can sort either by amount in crore or by percentage holding.
Okay.
And you can see all the funds that have a decent high sector exposure to chemicals.
Right.
And the same functionality is available for individual stocks also. So if you go to the next time, here you can see, I want to find out which stocks are holding the highest in Bajaj holding and investment, let's say. So just click on the fifth from the top. Yeah. So I click on this. Okay, these are the 4, right? So I know Parag Parikh Flexi Fund 7.91% is in that stock.
Fine.
Yeah.
There is another question. All schemes are regular, you consider, or direct?
So we have both options. So basically with holdings, it doesn't matter because obviously the underlying fund is the same. But if you go to, let's say, category averages, for example, you have a choice on the top. You can do regular or direct. Same thing when you go to, let's say, the screener section. You again have a filter plan. It's defaulted to regular, but you can just make it direct. Everything now you see will be direct funds. Again, same thing in the compare section. When you're adding a fund, just search for one particular name or something that, so you see direct and this. And also when you add groups, like adding a SEBI category or all AMC fund, there's a little drop down there. So you can do it direct. And now if you add a category, it'll add only the direct versions of all the pharma sector funds. So there are many other places where you will see this, but there is direct and regular are both catered for equally. How can we know the style of fund, value style or growth style? Do you mean like the investment style or something? Is this the information is shared by the AMC? Then we can check if our data provider has it. Okay, so it is shared by the AMC. Just click on any fund where just any of the funds in the portfolio. Let's see what we see on the top. So there's category, riskometer. Okay, so there's no style. So we will check, sir, if this is one of the data points that is given to us.
No, Arnav, there is no concept from the AMC.
Okay, okay.
The value or style.
They don't. Yeah, they also.
There is no style.
Achha.
This has been derived by some other platform.
I see.
And there could have been a practice by some of the advisor, but no AMC will tell what kind of style they are using.
So style again, then there has to be a process. Of determining what the style is.
No. I told you, there is some other platform, value research. So I am aware of all this. So no AMC will ever tell anything like value or style.
And obviously, the other question is, what is the process by which they determine the style? That has to be made clear, right? So, I mean, generally speaking, everything you see on our platform, everything has a Excel explanation of it. So, if you're seeing in other platforms that one particular values fund style is this or that, there should be some clear explanation as to why.
I don't think it will be reliable enough also because it's only
because,
the who make it.
Very simple example. If we are so confident about using these stars, which are ranking methods used by different other platforms, don't want to name them. Then today, I think all those who have invested in the 5-star category funds or 4-star, whatever you mentioned, and no losses, nothing would have happened to those portfolios, right? If you were so confident, but that didn't happen, right? I have spent almost 25, 26 years in advisory. I have seen that doesn't work anymore. Never it worked actually.
Yeah.
So, but you need to understand, if suppose we have decided that if suppose anytime in future we come up with a ranking method or ranking rather, we should be displaying the formula over there. What's the problem? You don't even know why they are ranked number 5 or the best. Getting 5 stars. You don't even know. Why we don't know that a fund has got 5 stars? Just on the basis of return? No, certainly not. You cannot judge a fund on basis of returns. So all these kind of value, style, ranking methods are all in Indian industry, which are practice been going all throughout these days or last so many years, and not been correct at all.
Yeah, and we must be very careful with ratings. I mean, if anything we've learned from the 2008 crisis is we all know what AAA rating is worth now, right? So all the debt papers that defaulted in 08 were AAA rated by Moody's, by S&P, right? So ratings have a way of kind of catching up on you. So we have to be, I mean, our advice would be careful of ratings.
Right.
You should watch that movie, The Big Short. It has a very good explanation actually of the 2008 crisis and the ratings fiasco.
What was the movie there?
It's called The Big Short.
Big Short. Okay.
The Big Short. It's actually very, very relevant. I was in London at that moment. I was working in a bank. So it is very, very, it's a very, very real depiction of what went on.
Okay. Big Short. So we'll see that.
Yeah, definitely. Are there any other questions from anyone?
Sir, I have one question.
Yeah, please.
What is how to use ranking and value model, sir? I don't understand. Can you please explain?
Sure. So basically, these are just kind of suggestions from our side. And the difference between the ranking and value model is that one is much more concentrated towards the best performing funds. The other ones are less concentrated towards best performing funds, and they're take a bit more balanced approach. So now this is up to you as a user to decide which one makes more sense. In fact, here, if you compare the rank return model on the left side with the ranking models to the returns value on the value column, you will see, again, one is balanced and the other one on the rank return side is not that balanced. So like I said, the ranking part is very, very concentrated. The value models are a bit more balanced in nature. So if you want to take a more aggressive approach, we would suggest you take the ranking models. If you want to take a more long-term balanced approach, then you should go for the value models.
And in this funds you have shown, is your suggestion for may I change the fund names?
Yeah, so you can create any portfolio with any number of funds in it. Once you create it here, and you just run analytics, and then you can optimize that list of funds.
Okay.
So you must provide the list of funds first, and then we can give you mathematically generated suggestions.
Okay. Thank you, sir.
No problem. Any other questions? Okay, Umair, I think we can go ahead and close for today.
Yeah.
Yes. So thank you everyone for coming for this webinar. So we are gonna have next webinar on Friday, 4 o'clock, and we will email every one of you. Please do attend. And one more suggestion here to everyone is please check out the YouTube channel. We are actively adding all the videos which we are having the webinars of. So if you have missed out something, you can look into the webinars videos here, and we are also going to be adding some functionalities videos soon, so that can give you all the tutorial videos. All those doubts and everything will be solved in the webinar itself. And if you have any other doubts, please contact us on support@engineresearch.com, and I'm just typing the email here so that everyone can view this this particular mail. And anything else, do let us know, do contact us. We will definitely give you all the handholdings and everything. So thank you so much, and have a nice day. Have a nice weekend.